welcome back Adi Imsirovic, Senior Research Fellow at the Oxford Institute for Energy Studies, Neil Atkinson, former Head of Oil Markets Division at the IEA, and Jorge Montepeque, President and Founder of Global Markets. Gentlemen, welcome.
Thank you.
Good day from Paris.
Good day from Paris. We got Guatemala, and Adi Imsirovic in the Caribbean, I think. Is it Caribbean via Surrey?
No, it's it's sunny Surrey at the moment, I'm afraid.
Sunny Surrey. That lovely sunlight that was there earlier seems to be fading a little bit. But we want to look at the deep experience of all of you guys on where the trends are going that are going to give the market direction in this coming year. We had a period during the COVID year where it was just sentiment driven sort of wind in the sails of one direction, and then obviously uncertainty arrived. And I wanted to get a sense of, what do you think the trends are going to carry over into the new year? And Adi, I wanted to kick off with you about the war in Ukraine. It seems in some ways the energy markets, the oil markets have priced in this war, and unless there's something dramatically different, they're not going to be a factor in 2023 to determine the direction of oil markets. Is it one of the 5 dominant trends, do you think, for the year ahead?
Well, it's definitely a dominant trend, and it's not so much the war itself, but the consequences of the war that are really important. And I'm not really sure that it's just going to carry over. I think there is a big question mark and a lot of unknowns. In particular, as Amrita earlier mentioned, it's to do with the products export sanctions. I think products are going to be a difficult one. Crude, there will be some impact, but the price cap imposed by G7 served as a vent, and it was deliberately imposed to actually enable Russia to export more crude. So we're seeing almost as usual Russian crude exports. Products exports will be a lot harder because it's obviously exported in smaller volumes, exported directly to Europe, most of it, especially gas oil. Europe was the market for gas oil. And I think shipping for products is a lot harder as well to find the adequate shipping. So finding sources for example, Russian gas oil in Africa will be the next big thing. And if I was to start my own trading company right now, I'd probably be looking into something like that to do. It's going to be a big.
If Vitol and Trafigura would leave any space,
anything that's legal, I think would make a lot of sense, because that's going to be a difficult one. As I think we looked into it at the institute, probably at least a third of that gas oil will be struggling to find homes. So there will be an impact. It will be carried, but we still have to wait and see what happens in reality. So that will be one trend. The other one, as I mentioned, consequences of the war rather than war itself, is the government actions. I think, to me, what's really appeared towards the end of last year was that most of the volatility was introduced by our own governments, and uncertainty as regards to the policies, what's going on. The price cap went on for months and months, and there were rumors, and we didn't know what was going to happen. Again, with products, we have the same story. We have a price cap on products. There are going to be 2 caps for lighter and heavier products. We just don't know what the heck is going on. And I think that volatility, that is definitely increasing volatility in the markets. And that may be one of the reasons why a lot of players in the oil markets are actually staying out, rather, as opposed to other commodities, is because this uncertainty introduced by our own governments. Not to mention, now, I don't want to go into gas, but it's the same story.
Neil Atkinson, former head of Oil Markets Division at the IEA. Another big trend from last year, Neil, was the extensive use of strategic petroleum reserves. Of course, under the IEA rules, each country should hold 90 days of cover. Your thoughts on whether the SPR continues to be an impact for oil markets? I know it annoyed the hell out of OPEC Plus that it was a factor in the markets and dictating in direction of price. Your thoughts on where strategic reserves plays a role or not in the year ahead?
Well, the US SPR releases in 2022 clearly did play a role because it averaged pretty close to 1 million barrels a day over a period of several months. So, that is not small. And of course, in the case of the US, since their domestic oil production started to shoot up with the shale phenomenon, their requirements to hold 90 days of net imports essentially has disappeared because they're the net exporters of oil. So they were perfectly entitled to reduce their SPR by almost any amount that they saw fit. However, as we move into 2023, the obligation, as far as we understand it, or the stated policy of the United States as we understand it, is that they will start to restock the SPR on the assumption that the price falls to a certain level, which is, I think, roughly $70 a barrel, I think, for WTI, something like that. At the moment, we're not quite down to that, but we're getting close. And so I would think that during 2023, which is not an election year, and this is crucial for the next point, it's not an election year, they will buy oil for the SPR. So it will be a factor, if you like, on the demand side. And just quickly, if we're having this conversation a year from now, the US presidential election year, I hope to God we're not going to have the same psychodrama that we had in 2023 with various US initiatives, whether it be the SPR, outreach to Venezuela, the Iranian talks, and various other stunts that they tried to come up with to manage the oil price. But for now, the SPR, they've used it. Not for the purposes for which it was intended, of course, but they've used it for their own domestic purposes. But now they're going to restock, and that will be a factor in the market, assuming the price remains at the levels which will trigger purchases.
Let's welcome Jorge Montepeque, president and founder of Global Markets. Jorge, I wanted to get your thoughts on where we just had the IMF on the 1st of January tell us that at least a third of the world is going to go into a recession this year. And then at the same token, we have China reopening. These two forces, which do you think wins out from the point of view of oil demand, the direction of oil markets? You're on mute, Jorge, you're on mute. Boom.
Apologies.
Pleasure.
Well, good morning, good afternoon, and good evening, depending
welcome.
where you are.
It must be very early where you are. That's what I would say.
Well, greetings from the third world, or emerging world, if we're more polite. I think if we take a very broad view, Europe is self-punishing itself and is the entity that is going to come off very short in this broad economic and military confrontations, because it's damaging the core of its economies. The US is going to be—
Sorry, just to pick you up, punishing itself, just to give us a little bit more on that. That's a big statement.
The sanctions and the economic friction being placed is on itself. There's an industrial move to reposition industrial activity elsewhere. The economic growth in energy consumption countries is going to drop. And I'll give you a little example. I met a Mexican manufacturer of high-end products, bottled products. And he was buying the bottles, fancy bottles from Italy, which cost him roughly 15 Mexican pesos per unit. And in the New World, he was quoted 72, which is a sizable increase. But glass requires a lot of energy, and the Italians essentially price themselves out of the market. This Mexican producer, of course, is going to acquire its glass bottles from elsewhere, essentially from Mexico itself. This is just a minor example of the impact of gas price, power prices in the production line, and how Europe is going to find itself being marginalized by itself. This will cause, and is causing, a reduction in industrial demand. And at the same time, China is coming back from COVID. I never also understood why they were self-punishing themselves by restricting themselves so badly that their economy now has no hope of growing faster than the US or overtaking the US. That line has been extended perhaps decades now. And those two factors are almost counterbalancing each other, where I think the industrial might of China is bigger than the reduction in Europe. So the marginalization of Europe is actually far more severe. But there's a third element here, and that is what I would call the Mexican bottle manufacturer element. The emerging world stopped taking notice of the war. 6 months ago, everybody here was very worried about inflation and the access to primary products, be it fertilizers, metals, and energy itself. I have been traveling a little bit, visiting with some companies in the area, and they are no longer worried. And in fact, here, visually and in people's behavior, the growth is massive. And there is an issue of underreporting on the figures, underreporting even on profits and things like that. And what I can see visually is the line of cars in all these capitals. Traffic continues to grow, consumption continues to grow. So the world always resets. And we shouldn't forget, Neil Atkinson made a very good point on the US providing a lot of SPR oil to the world. Depending how we count that, the time period is close to 1 million barrels a day, right? What the US was providing. If the US starts buying, that would be like minus 1.5 million. And the impact of that, either -1 or -1.5 million in the overall global balance, coupled with the surge in China's consumption. And you can see the queues of Chinese people trying to renew their passports to go traveling. So no wonder the planes are, consumption of jet fuel is rising. Yeah, go ahead.
No, I was just going to just flip over to Adi and say on the point of this sort of China reopening story and the stress in Europe vis-a-vis the war, that the oil price is sitting sort of somewhat nonchalantly at $80 a barrel doesn't seem to reflect stress anywhere. It doesn't reflect the belief that China is going to go demand boom boom, and doesn't believe that the Russian crisis is some. Well, how do you interpret $80 sort of sedate barrel of oil?
Well, it's maths, Sean. It's we are expecting probably a growth next year, on average for next year, of about, let's say, 1.7 million barrels in demand. And in terms of supply, we are going to have non-OPEC itself. Just non-OPEC is going to supply almost certainly 1.5 million of that. So the numbers are there that, you know, the market shouldn't really react that much to it anyway. I do agree that China will come back. There will be a lot of pent-up demand, but it's not going to go in straight lines. China lost about 500,000 barrels of jet demand, I think. Well, 500,000 barrels is not exactly a massive number. So there will be, we are also sitting right now at the period of time when we have relatively low demand seasonally. So Q2, Q3, we will see pickups again. So most
could we
likely,
see the market structure shift to contango?
I think, well, we are in contango. Brent front is in contango. WTI, all the front months are in contango already. And that's actually telling you the fundamentals. These are real fundamentals. The market, physical market, is telling you it's not very strong, simply because there's plenty of oil out there. Let's not forget OPEC. You know, we haven't even touched on that subject, but you know, OPEC is still, anyone, you know, within OPEC who can cheat, they do cheat. If they can produce, they do produce. Saudi Arabia aside, of course. So,
I mean,
you
there's
know,
a general narrative that Saudi and the UAE are the only ones with idle capacity. They're the only ones not producing at full capacity. I mean, every other member, other than Russia, probably
yeah.
seems to be at fully loaded.
And the worry is obviously now the issue is what is the recession? What's going to happen? It looks at the moment that that recession is going to be relatively shallow, most of all in the United States, which is the strongest out there, I think. And even in Europe, it doesn't seem to be too strong. But if we were to see a stronger recession, I think OPEC would be back in the situation of 86, where essentially Saudis are cutting and cutting and everyone else is producing until the Saudis say again, hello, you know, either you stop or we're going to flood the market again. So that situation is real and was real, especially a couple of months ago with the situation in China. So I think the market is kind of backed off and said, well, just too many unknowns out here, from COVID to the war. And most of all, as I said, government action. We still have to see what's going to happen with the Russian exports of products. We could easily lose 1.5 million barrels of Russian exports. That would be rather bullish, but we don't know. Our markets usually work very well, and so far, you know, we've been able to find a way around because the global market is very, very efficient, and eventually they always find a way of trading these barrels that you're not supposed to trade. And you would know over there. I was talking to a friend of mine a few days ago. He says, well, hey, you know, everyone is in Dubai right now and trading Russian stuff. And apparently, you tell me, but 20 to 30 direct flights to Dubai from Moscow to Dubai at the moment. So markets are efficient. They always find a way of around these sanctions.
Well, as long as there's a gateway like Dubai, the markets can work. Neil, I wanted to get your thoughts on what trends you think carry through, and we're sort of trying to get into the top 5 and where you guys think are on that top 5 list. You still have a sense that the Ukraine war is one, and the question, Neil, I have for you is the European energy crisis over, or did it ever really start, or where are we with Europe's energy crisis, and what other trends do you think carry over year on year? And you're on mute, sorry.
Yeah, just quickly on that, I was listening obviously with great interest to what Adi was saying. I might have bought his 1986 comparison if China had remained locked down, but I don't think it's highly likely to occur given that China is returning. But it was an interesting point anyway, and thanks to him for that. Now on my cheat sheet, I've actually got 6 sort of bullet points that I've boiled considerations down to. As far as Europe, before we get on to those wider issues, as far as Europe is concerned, a huge difference has been made this winter by the fact that we've had mild weather, and that has made an enormous difference. You know, if for the sake of argument, we'd had a really cold October, November, and it had carried through the Christmas end of year period, you know, we would be in a very, very different situation. The natural gas stocks would have been depleted very heavily. There'd have been greater demand, obviously, on alternatives, whether it be heating oil or whatever. So the weather has been, I think, possibly the most decisive factor. And it will still be the same.
And does that create a buffer, Neil, for next winter?
Well, yeah, because unless we do get a later cold spell, which is of course very possible. I have looking at some happy snaps the other day of snow on the ground in central Paris in the middle of February in 2021. So it's possible. But and if we do get that cold snap, that will obviously deplete the stocks. But if for the sake of argument, we maintain the current pattern that we've seen on the whole throughout the heating season, then we'll enter the spring period and therefore start to look at restocking from a much higher base than we were anticipating just a few months ago. Europe will actually be in a pretty strong position. But then, of course, with China re-emerging and with competition for LNG cargoes from other buyers, then obviously we are going to be in a big scramble, and that will lead to higher prices. So Europe will obviously have to prepare for next winter, but at a great cost. And you know, whether it really is shooting itself in the foot, as Jorge was suggesting earlier, is a debating point, because obviously the morality of the Ukraine war is not to be discounted. But Europe has weathered the crisis pretty well so far. even though there has been great cost to end users and governments have had to spend a lot of money to offset the impact on the end consumers. But in terms of keeping the lights on, keeping heating systems on, Europe has managed to get away with it.
Jorge, you mentioned there earlier about this structural, that the global south. You're sitting in Guatemala today. I wanted to get your sense on the scale of this rupture. The global south's no longer paying attention to the war, and many of them never even started, but they were impacted by the fallout of the war, i.e. the rise in food inflation, the strong dollar, and we had an interesting interview earlier this afternoon with a Russian expert who was sharing her views about how the outlook of the war is a little bit misunderstood by the West, that Tatiana Mitrova, who I presume you know, Tatiana was saying that the West thinks it's treating it like a local war, a regional war between Russia and Ukraine. Russia's treating it as a global war to create a fracture with these emerging economies, emerging countries that are fed up with this sort of Western architecture of the world. And that fracture is something that is much bigger, and that the West really isn't in tune to that. They're obsessed with this as a kind of regional NATO narrative. Your thoughts on that, and from the perspective of your earlier comments?
Yes, I think actually both sides know that the war is bigger than Ukraine, Russia. Is nibbling at the foundations of the Western leadership for the past actually few hundred years, from colonization to the overwhelming power of the US in the 20th century. And I have had these discussions a lot in Europe and also during this trip. And essentially the feature that comes out is that the rest of the world has grown up. China has already super grown up. Southeast Asia has grown up. Latin America, who has been bombed many times, is also growing up and exercising its leadership and connections. And you can see how Russia is very supportive of the current government in Brazil. They want to make sure that Latin America exercises some of that freedom and actions that come from just growing up economically. So what we are seeing here is a potential reset of how the world has been run for hundreds of years and very much in the 20th century. And what this means is the following. The export of oil products from Russia, again, Europe will shoot itself in the foot because it will need to acquire products that come from the Middle East that shouldn't. They should be bought directly from Russia, lower freight costs, lower transportation in pipelines. They're just going to suffer, right? Self-inflicted wounds. But if China is growing, which now it will export less. So there will be fewer products for, let's say, the crop season in South America. And they will need to buy the diesel. And that diesel, I can bet my last dollar or pound, will come from Russia, directly or indirectly. So all these old systems are being tested. And at the end of the day, people need to do what they need to do and things rebalance, which is the point that Adi was making. The world finds a way to live and secure what it needs. So I am not overwhelmingly worried about what will happen in terms of supply and consumption. I would agree with Amrita that on the whole, the bets are to the high side on price as China comes back, overwhelms the shrinkage in Europe, and the emerging world carries on consuming. We have a big negative, which is interest rates. And we haven't discussed that. That does slow down the world. But you can see many countries have kept up the exchange rate in line with the US, if not stronger, because they do export things that the world needs and that now even Europe is buying. So on the broad, the world is going to be tighter in energy in 2023, but not excessively. The big worry, and I do have one, is that the West is trying to tighten the vice too much in China in terms of technology and Taiwan. And China is led by a man that has a clock ticking in terms of his age and his leadership. And he doesn't have many years left to leave a strong legacy on China. So if I were a leader in the West, I wouldn't be pushing him too much because he may decide, like Putin, I don't have many years left to actually execute what I want in this country. That is the big worry, and we could see some very bad surprises in 2023 or 2024. I hope I answered the question.
Yeah, no, that's very very helpful. Adi, the other sort of big story or trend, I don't know if it was a trend, but certainly a trend in terms of its noise, and it resurfaced at the end of last year with the visit of President Xi to Saudi Arabia, and that was the de-dollarization of pricing of commodities and of oil into Asia. And obviously that's something the Russians had talked about during, and have still talk about during the sort of, since the war with Ukraine and even before that. Your thoughts on what that means for whether it has legs, whether it's viable, and what does it mean for oil prices and oil markets? We already have Russia pricing its rubles. I don't know how it's pricing it exactly, but nonetheless, I'm just wondering the de-dollarization and the existing price architecture in the world, Brent and WTI and so on.
Well, it's an excellent point, and leads back to my original first point that I made in this conversation, is this increasing role of governments in the markets, both oil and gas markets. And well, what they do, they just make impediments to normal functioning of the markets and make it a lot harder. To directly answer your question, what I think about de-dollarization, I just think not very much. I think it will make some difference for local trades between India, Russia, China, Russia, and so on and so forth. And for a good reason, because the US has really politicized the sort of use of these financial sanctions and so on. And of course, it's inevitable that some avoidance of those sanctions and the dollars will happen. But in terms of markets, I don't think there'll be, I don't see much difference. Again, I'm very, very worried, going back to the point that Neil was making about next year and gas. Okay, so far Europe has come up with two things, is this sort of cap for gas, which essentially is similar to the G7 oil cap, is really designed not to do anything, just as it pretend that something's being done. And the second thing is this chase for the new benchmark for gas. That one worries me a lot more. Whereas while Europe has come up with this new benchmark of spot LNG deals in Europe as it'll be purely voluntary, it's still that sort of involvement of the government is very, very scary, because as Neil said, the reason why we have no energy crises in Europe at the moment, yes, prices are high, but everything is fine, everything's functioning perfectly well, and everybody's nice and warm, is for two reasons. We're lucky, China and weather, and number three, because TTF was a lot higher than JKM, as simple as that. Markets work. So if we somehow pressure TTF to be equal or below JKM, we're toast. Basically, we have shortages. And we know, Soviet Union control prices. Whenever you control prices, you have big queues or shortages, one of the two, as simple as that, until it eventually collapsed and the Soviet Union is no more. We live in a market economy for a reason, because it works. And I think government should be very, very careful about tinkering with the market and market prices, especially in the areas where they work.
Well, it seems like the that train has left the station as we talk about price caps and de-dollarization and so forth. But now comes the final sort of piece of our puzzle together is where we want to get you to sort of stand on your pedestal and give us your oil price forecast for the year ahead, as we also got from Amrita, which sort of blew my head off a little bit as to the number she put forward, above $100 a barrel. That was certainly of our day so far the most bullish outlook. But nonetheless, welcome, Neil. Start with you on that, and then some of the reasons why you think the oil market will get to where it will get to.
An oil price forecast, my God. Oh, is that the time? I think I'm going to have to go. Sorry, Sean.
You're not in the IEA anymore, my friend.
No, it's true. I can actually say what I really think.
There you go.
What a luxury. Yes, well, at the IEA.
You'll still get your pension, I hope. They won't.
Well, I don't have one. They didn't
right.
Long enough. No, well, the motto at the IEA is, of course, we never forecast short-term oil prices.
Exactly.
I used to not then go on to say there are already enough idiots out there making a fool of themselves doing that as well. But intuitively, because I do believe that China, on balance in 2023, is going to come back strongly. I think the days of mass lockdowns are over. We've seen that the patience of the Chinese people was stretched to the very limit. So China is going to be strong. We will finally see.
You think that was the engine that drove the rapid shift, was the fact that there was those protests on the streets? I mean, it seemed
I guess so. I think the experience of Chinese people was horrendous compared to what we experienced here in Europe. Eventually enough is enough, and those protests clearly spooked the regime. So on the basis that China does have a pretty strong 2023, where demand will grow year on year up to, 1 million barrels a day, you can take your pick. There will be an impact on international aviation, and aviation has been the laggard in terms of the recovery of demand from the peak of the COVID pandemic in 2020. So we should see plenty of support from that. But on the other hand, as Adi mentioned earlier on, unless something changes, we are going to see significant increases in production from Brazil, the United States, Guyana, Norway, probably a few other, Lunistan or somewhere that I've not remembered. So, there's going to be a significant global demand growth, 1.7, 1.8 million barrels a day, but there's plenty of non-OPEC supply out there. And OPEC Plus lurks in the wings. They can be flexible. They can make changes to their production levels or their quota levels as they see fit in a flexible way, which we've seen since the pandemic started in 2020. So I'm, fairly, I'm a PES optimist as far as the price is concerned. I think the $90 to $100 a barrel for Brent is roughly where it's going to be on average in 2023.
Jorge, I welcome your sort of outlook on price as well, but also I'd welcome if you would address OPEC Plus. They seemed to get through last year with some fairly difficult moments of challenge in UAE and the idea of getting new quotas, and then Saudi with America about cutting, and the geopolitics of being aligned with Russia. And I'm wondering, does OPEC Plus face any structural challenges this year, in your opinion? There policy choices ahead, and where do you think, obviously, price outlook goes?
No, I think OPEC and OPEC Plus are sitting pretty right now because they're facing two very strong demand boosts: China and the eventual retreat by the US in supplying SPR world oil to the world. So if you combine those two things, it's over 2 million barrels a day of demand coming out of nowhere. And then, as I said, the emerging world is actually doing extremely well, and that will continue to grow. So the only negative in terms of consumption is Europe. And I think we will see some reduction there as we go forward, but the rest of the elements are very positive. If you have then an organization that makes more money when demand grows and everything is scheduled to grow, then they're going to sit pretty. And then in my price prediction, I very much come in line with the comments by my other colleagues in this chat, and that is the only thing that worries me, because I'm squarely yes, I'm squarely looking at 100, with the proviso that if we look at the market last year and this year, it's extremely seasonal. So we are now going through the slow spring period, and the markets work in advance. We will see the surge as we go into the market for the summer. And middle distillates will lead that. It will be jet fuel and diesel powering up the surge. As we go into the fall, I think there'll be a lot of industrial changes in Europe, where finally some of the gas will be at the margin cut down and fuel oil will be restored. On average, all these things point to the $100 market. So I am sitting right squarely with the others are, and I have to be very fair. I don't like that, because when you hurt into a total prediction, you know it's wrong. And then with the proviso that we don't know what's going to happen in China and the war. Russia seems very committed. Ukraine is very committed, but so many people are dying on both sides. But Russia is bigger than Ukraine. So at some point, Ukraine will have to essentially accept the inevitability that debt is a high cost to pay. But it looks like a chronic thing right now. And that creates a lot of grit in the world, which Europe pays for. So that's essentially my prediction: $100 oil and a slowdown in Europe.
Adi, it's your last word with you. I do struggle to see how these things coexist. The 1st of January, the IMF Director General comes out and tells the world is ending, i.e. global recession. We had Martin Wolf in the FT today, and Martin Wolf is a fairly competent macro economist, saying very serious distress potentially in the global south, Jorge's neck of the woods, with possible debt defaults and dollar-denominated debt burdens that are unsustainable at 5% interest rates. So all of that coexisting with $100 oil, I struggle with. But nonetheless, your thoughts?
Well, you're absolutely right. I mean, let's not forget $100 oil is in nominal terms. I mean, when you discount it for inflation, it's actually, oil price is not particularly high at the moment at all. So let me just take a step back. I'm not as bullish as Jorge for sure, but you know, I think oil market is seasonal, and for many other reasons, I think we're going to see very uneven year. That's why it's kind of, we have to give some averages. If you want, I'll give you right away. I'll say between 80 and 100. We will have spikes on either sides a little bit. Currently, oil market is well supplied. There's plenty of oil around. There's a very good reason why the front end of the market is in contango. CFDs are very, very cheap. Plenty of oil around, not an issue at all. There's still big question marks regarding demand and so on. Agree with both Neil and Jorge regarding the potential demand and return of China. I think we've seen it actually for the first time early last year, even before the war, when when we had pent up demand in Europe and suddenly demand just basically blew up. Now, how long is going to last? Probably not very long, but Chinese growth even then is very unlikely to be much higher next year than probably 5%. So even that is not going to make a big impact on the market. I think maybe we'll see $100, a little bit above $100, with jet demand growing again back close to $750 a day. As Neil mentioned, I agree with his numbers, probably total non-OPEC supply, including everyone in Canada. I think we're going to meet that demand reasonably well. Now, huge question marks. Second half of the year, I think, will be strong. We'll probably see good gasoline demand, and then going into jet and so on. So we will see something closer to 80 this year, and we'll see something much closer to 100 later on next year. But am I super bullish? Not particularly, really. I still think, I've said many times on your show, Sean, I think high interest rates don't go along with very high oil prices. and you discussed that with Amrita very much. I think it's very hard when you have your margin calls very high, when you have time value of money very, very high. It's hard to take big punts on the oil market, and they can easily go wrong. So all the longs for the last 3 or 4 months have actually done pretty poorly. So that's about it. Sort of kind of year or two sides, not particularly bullish this half. Second half probably a lot more bullish.
Well, listen, that's an amazing hour. Really, I couldn't have had 4 greater voices at the table. Really, thank you, Amrita Sen from Energy Aspects off camera, Jorge Montepeque from Guatemala, of course, Adi Imsirovic in the UK, and Neil Atkinson in Paris. My sense, for what it's worth, the pennies of China reopening could be solid, but it's not a return to building 5,000 miles of road and 5,000 miles of railway. It's a new China in which energy consumption is not core to the activity in which the new economy is looking to be built on. And so I do think we're in peak oil demand territory in China. I mean, pre-COVID peak oil, i.e. 15 to 16 million barrels a day. How that adds up, it still gives you an extra 1 million barrels of recovery this year. But I think that sort of long-term framing for China, the idea that it goes back to being the boom of stimulus into cement, I think is probably not a factor. How that impacts demand on energy, we will wait and see. But really great. Thank you, guys. Look forward to catching up with you on the Daily Energy Markets podcast, which kicks off again next week for the new season. But for today, we will wrap up the European section of our tour around the world. We've been through Asia, Middle East, now Europe. In half an hour, we'll take a break for half an hour, and we'll kick off in the Americas with 2 really unique interviews on the outlook for investment in oil and gas in America. One interview on the LNG side, the other interview on oil production. So tune in there. Thanks, guys. All the best. And again, I'm Reid off camera. Thank you.
Pleasure.